Every single time, right before the collapse, investors felt safe. The charts looked strong, the experts were confident, and the people warning about danger were laughed at or ignored. Then one morning, everything changed. Fortunes built over decades disappeared in days. Banks failed. Families lost everything. And the world asked the same question it always asks after a crash. How did nobody see this coming? The truth is, somebody always saw it coming. But greed, fear, and the dangerous belief that this time is different made sure nobody listened. This is the Hidden Archive. 10 crashes that shocked the world. 10 moments when markets told investors exactly what was about to happen. And 10 times, investors looked away. Let's go back to 1720. The South Sea Company had convinced the British public that it held the keys to unlimited wealth through trade with South America. Share prices exploded. Lords, ladies, merchants, and servants all bought in. Everyone was getting rich. What could go wrong? The company had almost no real trade happening. The profits were fiction. Company insiders were selling their shares quietly, while the public kept buying at higher and higher prices. When confidence cracked, the collapse was instant and brutal. Fortunes vanished overnight. Members of parliament lost everything. The lesson was simple. When a story sounds too good to be true, and everyone around you is buying in, that is not safety. That is a trap. Almost 2 centuries later, in 1907, the United States had no central bank and no real system to stop financial panic from spreading. A group of speculators tried to corner the copper market and failed spectacularly. That failure rippled into banks, which started collapsing one after another. Depositors ran to pull their money out, which made the banks fail faster. It took one man, J.P. Morgan himself, to lock powerful bankers in a room and force them to pool their resources to stop the bleeding. The lesson from 1907 was that panic feeds itself. When people believe a bank will fail, their panic makes it fail. Confidence is fragile, and without a safety net, fear moves faster than facts. Then came 1929, the Roaring Twenties. Americans were buying stocks on margin, meaning with borrowed money, betting that prices would only go up. Radio stocks, automobile stocks, anything modern and exciting. The economy felt invincible, but debt was piling up quietly behind the scenes. When prices started to slip in October, margin calls forced investors to sell. Those sales pushed prices lower. Lower prices triggered more sales. In 4 days, the market lost a staggering amount of value. Banks failed. Unemployment exploded. The Great Depression swallowed a generation. The lesson from 1929 is one investors still refuse to learn. Leverage turns a bad market into a catastrophe. When you borrow to invest, you don't just lose your money, you lose money you never had. Fast forward to Japan in the 1980s. The Japanese economy was the envy of the world. Real estate and stock prices seemed to rise without limit. At one point, the land under the Imperial Palace in Tokyo was valued higher than the entire state of California. Banks lent freely. Companies borrowed heavily. Everyone assumed growth would never stop. When the Bank of Japan raised interest rates to cool the bubble, the air started rushing out. By the mid 1990s, Japan's stock market had fallen by nearly 80%. Real estate collapsed. Banks were buried in bad loans. Japan entered what economists called a lost decade. Actually, it lasted much longer. The lesson from Japan is that when debt funds a bubble, the collapse doesn't just hurt investors, it can hollow out an entire economy for a generation. Then came Black Monday, October 19th, 1987. In a single day, the Dow Jones fell by over 22%, the largest single day percentage drop in history. There was no single obvious cause. New automated trading systems amplified the selling. Portfolio insurance strategies, designed to protect investors, actually made the crash worse. The speed was unlike anything markets had seen. Billions disappeared before anyone understood what was happening. The lesson from Black Monday is that technology and complexity do not remove risk. Sometimes they multiply it in ways nobody predicted. The Asian financial crisis of 1997 is a story that most Western investors barely remember. But for Thailand, Indonesia, South Korea, and others, it was devastating. These economies had borrowed heavily in US dollars, while their currencies were fixed to the dollar at artificial rates. When speculators attacked the Thai baht, the currency collapsed. Other currencies followed. Governments ran out of foreign reserves overnight. Millions of people lost jobs, savings, and futures. The lesson was this: when a system is built on borrowed stability, it doesn't weaken slowly. It breaks all at once. Then came the dot-com boom. The late 1990s felt like the future arriving early. Internet companies with no profits, no revenue, sometimes no real product, were valued at billions. Investors had FOMO so powerful that logic didn't matter. The story was that the internet changes everything. And it did. But that didn't mean every company with a .com in its name deserved a billion-dollar valuation. When the bubble popped between 2000 and 2002, the Nasdaq lost nearly 80% of its value. Trillions of dollars in wealth simply ceased to exist. The lesson from the dot-com crash is that a real technology revolution can still produce a devastating financial bubble. Innovation and investment returns are not the same thing. 2008 was different in scale, but identical in psychology. Banks had packaged millions of shaky mortgages into complex products they barely understood themselves. Rating agencies gave those products top safety scores. Housing prices were assumed to only go up. When they didn't, the entire system started to unravel. Bear Stearns collapsed, Lehman Brothers fell. Governments around the world scrambled to prevent a total meltdown. Trillions were lost, millions lost their homes. The lesson from 2008 is that complexity hides risk rather than removing it. And when institutions tell you a product is safe, ask who profits when you believe that. In March 2020, the COVID crash happened faster than any crash in recorded history. In roughly 30 days, the S&P 500 lost 34% of its value. Fear was total and immediate. Investors panic sold everything. But then, almost as fast, markets recovered. Government stimulus flooded the system. Stocks roared back. For some investors, the lesson appeared to be that crashes are buying opportunities. But the deeper lesson is more uncomfortable. When central banks can inflate markets with printed money, prices can disconnect completely from economic reality. That creates a different kind of danger. Slower, less visible, but just as real. And then, crypto. 2022. Bitcoin had reached nearly $69,000 in late 2021. Influencers, celebrities, and everyday people were convinced that digital assets only went up. Then interest rates rose. Leverage unwound. Luna, a major crypto project, collapsed to nearly zero in days. FTX, one of the world's largest crypto exchanges, turned out to be built on fraud. Billions vanished. The lesson from 2022 crypto was ancient. Herd mentality, leverage, and a narrative that says, "This is the future," can make almost any asset look like a sure thing. Until it isn't. 10 crashes, 10 different decades, 10 different triggers, but always the same human behaviors underneath. Greed drowning out caution. Debt masking fragility. Confidence turning into arrogance. And warning signs dismissed by people who needed the party to keep going just a little longer. Markets don't collapse because of one bad day. They collapse because of months or years of decisions made by people who told themselves this time is different. And every single time, it wasn't. The archive never closes. History doesn't stop repeating. It just changes its costume. If you want to keep opening the archive, subscribe now. More dark money history is coming.